JP Morgan just dropped a bombshell and it's got everyone talking. Optimism is plunging, jobs are on the chopping block, and demand across the economy is falling fast. But here's the kicker. I think JP Morgan's completely wrong about what's coming next. Let's jump to the Bloomberg headline that started all this. JP Morgan drops U.S. recession call after U.S.-China trade truce. That's right. Just because there's a temporary 90-day truce in the trade war, they're suddenly backtracking on the recession call. But here's why that's terrifying. The U.S. economy was already heading toward a recession alongside the rest of the world. What's even more concerning is how the markets are behaving. Equity markets could melt up in the short term, and you better believe JP Morgan will take full advantage of that. Remember, they were the same ones telling their hedge fund clients to short the market not long ago. Now they're flipping the script, and everyone's going to chase the upside until the rug gets pulled from under them. And trust me, JP Morgan knows what's really coming. Even they admit that recession risks are still elevated, just now below 50%. But let's be real, below 50% is still a coin toss. Businesses are cutting hours, workers are worried about their finances. When that happens, consumer spending dries up. A 90-day trade truce isn't going to magically reverse all of that. And let's talk about China. What they're doing right now behind the scenes is likely to enrage the White House. I don't buy for a second that this trade war will be over in 90 days. We'll be right back where we started, maybe worse, because this time investors will be all in on the stock market when the bottom falls out. Even JP Morgan sees a slowdown in hiring ahead, projecting a contraction in employment as labor demand weakens faster than labor supply. That's the real problem. When labor demand disappears, people lose jobs, incomes drop, spending tanks. We're already seeing it reflected in the University of Michigan and Conference Board surveys. It all comes back to confidence in the job market, and right now, confidence is crumbling. So even if a trade deal happens, I still believe we're headed for a recession. But I want to hear from you, recession or not. Drop your thoughts in the comments below. JP Morgan also revised their interest rate forecast, now expecting the Fed to delay rate cuts from September to December. But, that doesn't make sense to me. If you believe rate cuts help, you cut before people lose jobs, not after. If someone's still employed, they can borrow and spend, but by December, it might be too late. Let's look at the data. JP Morgan agrees the unemployment rate is heading higher. Meanwhile, hours worked are falling, just like before previous recessions. Go back to the late 80s, early 2000s, or right before the 2008 crash. Each time we saw weekly work hours drop and unemployment rise, we ended up in a recession. And it's happening again. Surveys are showing declining work hours. Job cuts could be next, and if those trends continue, we're looking at an inevitable downturn. Now, if you think that's bad, wait till you hear what small businesses are saying. Optimism among small business owners has dropped for the fourth straight month. After the pandemic, sentiment soared, but now it's in freefall. That's a clear signal that consumer demand is weakening fast. So let's look at this from the perspective of a business owner. If your outlook is declining, what do? You cut employee hours, you stop handing out big raises, and in some cases, you start letting people go. The National Federation of Independent Business, NFIB, Optimism Index dropped 1.6 points to 95.8, its lowest level since last October, just before the election. 6 out of the 10 key indicators fell, led by a sharp drop in expectations for business conditions and a notable decline in job openings. And let's be clear, a pullback in job openings is a major red flag. Historically, when demand slows, the first thing employers do is reduce job postings and cut hours. That leads directly to smaller paychecks for workers. But just because paychecks are shrinking doesn't mean your trading account has to suffer. Take a look at this uranium trade we issued to our CTA Pro subscribers back on April 24th. It's already up 13.8% as of Monday's close and still climbing. We think it has plenty of upside left. Stick around until the end of the show. I'll walk you through the full chart and explain how we identified the opportunity. You'll find all the links, including a free 30-day trial, in the description below. Now, let's examine the relationship between job openings and average weekly hours for production and non-supervisory employees. Shown in red on the chart, it's crystal clear when employers reduce job openings, they're essentially saying, we don't have the demand to bring on more people. And at the same time, we don't even have enough work for the employees we already have. So what happens next? They cut hours. And when hours get cut, paychecks shrink. You can see this pattern repeat throughout major downturns, leading up to the global financial crisis, during the dot-com bust, and again right before the pandemic, which, by the way, was already shaping up to be a globally synchronized recession before COVID even hit. Fast forward to 2021, and job openings started declining again, another massive red flag. Even as the stock market was still trending higher, employers were clearly saying, "We overhired and demand isn't where we thought it would be." So, they started cutting hours. Then came a temporary boost driven by businesses front-running the tariffs. But now, once again, we're hearing the same thing from business owners. Hours are getting cut, and that means more shrinking paychecks. This will have ripple effects across the discretionary side of the economy. Less demand, fewer hours, smaller paychecks, and you can see the downward spiral forming. After peaking at a 4-year high at the end of 2024, the NFIB Optimism Index has fallen 9.3 points, the sharpest decline over any comparable period since the pandemic. This signals a sudden drop in business confidence, likely influenced by trade policy, but I don't think that's the root cause. To me, it's not about trade policy's direct effects. It's about consumer demand. We saw this downturn starting back in early 2025. Confidence was already falling. Why? Because many believed that once the election was over, especially if Donald Trump won, there'd be a surge in consumer spending. The idea was that pent-up demand would explode. But we pushed back on that narrative. We said just because you change who's steering the ship doesn't mean you change the direction it's headed. And sure enough, come January, businesses realized consumers didn't have the spending power and confidence plummeted. Only 15% of small business owners now expect better conditions over the next 6 months. That's down 6 points from March and marks the 4th straight monthly decline. Meanwhile, sales expectations also dropped 4 points. So while JP Morgan is dialing back its recession forecast, small businesses are doing the opposite. They're doubling down. They're saying sales are falling, we want to raise prices, we want to give raises, but we can't. Consumers won't pay more, and now we're stuck with too much inventory in a slowing economy. And with China slowing too, the situation is likely to get worse. Plans for capital investments have also dropped. The share of firms planning major purchases like equipment just hit a 5-year low. That means durable goods orders will likely fall as well. Again, despite what Wall Street says, small business data paints a different picture. So now I want to hear from you. Are we headed for a recession? Let me know in the comments. Now let's compare real retail sales in blue with average weekly hours worked in red. Every time businesses cut hours, paychecks shrink, and that hits the economy hard. Retail sales drop. You saw it in 1999, you saw it in 2007, you saw it again in 2022, where a clear turning point emerged. Hours continued to decline while retail sales tanked. Why? Prices were rising too fast, wages couldn't keep up, and consumers couldn't afford to spend. There was a short-lived bump in both hours and retail sales, but again, that was all about front-running the tariffs. It wasn't real, sustainable demand, and it definitely didn't translate into stronger business confidence. In fact, it was weaker than even we expected. Now, only 33% of businesses raised worker compensation in April. That's a 5-point drop and the largest decline since last July. And only 17% plan to offer raises over the next 3 months, the lowest figure since March 2021. So even with a brief retail boost, it wasn't enough to convince business owners to hand out raises. Why? Because they're still cutting hours, and that right there is the heart of the problem. At the same time that companies are handing out smaller raises, they're also cutting back on hours, and it's not benefiting consumers who are already facing rising prices. One of the most pressing concerns now, according to 10% of business owners, the highest level in over 4 years, is the soaring cost and shrinking availability of insurance. So here's where we are. Fixed costs are rising, the economy is slowing, employers are scaling back hours, and consumer demand is weakening. Prices continue climbing, but businesses are being squeezed from both sides. Eventually, those reduced hours could turn into layoffs. It's a serious problem, and businesses are hoping for a turnaround, but I don't think the next 90 days will be enough to make that happen. Now, JP Morgan says we're fine. I disagree. If you look at the relationship between average hourly earnings and average weekly hours, it tells a different story. What often happens is employers give a raise but then cut hours. So yes, the hourly rate goes up, but workers are clocking fewer hours. The result? Shrinking paychecks. And that's a classic signal that we're heading into a recession. We saw this same pattern during the dot bubble and again before the global financial crisis. But this time it's even more concerning because both average hourly earnings and weekly hours are declining together, something that rarely happens. To me, that's a clear red flag pointing straight toward a recession. Now, while that's happening, We're also about to see a rush to import Chinese goods into the US over the next 90 days as part of a temporary trade truce. This could really frustrate President Trump, who's hoping for a trade deal by then. But in my view, China is going to take full advantage of this window. The US-China agreement triggered a scramble to ship as much merchandise as possible before tariffs resume. This will bring in a wave of goods during the late summer peak shipping season. Sounds good for business, right? Well, not quite. The problem is we don't need more inventory. That's already an issue. And now we're about to see even more stockpile up, setting the stage for an inventory recession. Let's look at this chart comparing retailer inventories in blue with average weekly hours worked by production and non-supervisory employees since the 1990s. Rising inventories paired with falling work hours have been a reliable recession indicator. It happened during the financial crisis, and it's happening again now. We're already dealing with rising inventory levels. Over the next 90 days, they are expected to increase even further. Meanwhile, hours worked are being cut, and paychecks are shrinking. This isn't just about a recession we knew was coming. Now we're talking about an inventory-driven downturn and the risk of a deflationary spiral. Despite all this, U.S. inflation came in softer than expected for the third straight month. That tells us demand from U.S. consumers is falling. The old saying holds true. The cure for high prices is high prices. Here's the catch. All of this incoming inventory is priced higher, but consumers can't afford those prices. We're seeing clear demand destruction. And what's even more telling is that categories directly hit by tariffs, like cars and clothing, haven't shown the kind of price increases economists expected. That's because retailers and importers are absorbing much of the cost. Why? Because they know consumers can't handle any more price hikes. Businesses initially said they'd pass the costs on to consumers, but now many are realizing they have no choice but to eat the cost themselves, especially importers with wider margins. This is dangerous territory. Weakness is starting to show up in discretionary sectors, travel, entertainment, and other leisure spending, which means consumers are pulling back. And this is the flaw in JP Morgan's argument. When workers lose hours, their paychecks shrink, then they cut spending. That puts even more pressure on service sector jobs, which leads to further layoffs. It's a vicious cycle. Over the next 90 days, China will likely do what it does best: export deflation. The Chinese import price index is already negative, which will put downward pressure on the U.S. consumer price index. But that's not the only factor. When rising inventories meet shrinking paychecks, prices can't keep rising, and if they do, they won't rise by much. History backs this up. During the dot-com bust, as work hours declined, consumer prices peaked and then fell. Same story during the financial crisis, except energy prices pushed CPI up before it collapsed. And we saw the same trend during the pandemic. Since 2022, hours worked have been falling, and surprise, CPI has peaked and is now flattening or dropping. American consumers are maxed out. They can't afford more. One bright spot for now: gasoline prices. On a year-over-year basis, they're falling, which is helping to tame broader inflation. But once tariffs fully hit, we could see a short-term spike in prices, only to be followed by rejection from the market because consumers simply won't pay more. Central banks are closely watching wage growth as a signal for spending power, which is the engine of the economy. Recent reports showed real average hourly earnings up 1.4% year-over-year, matching the highest level since October. But that misses the point. If hours worked are falling, then rising hourly wages don't mean much because the overall paycheck is still getting smaller. And shrinking paychecks mean weaker consumer demand. That's why I believe JP Morgan is wrong. History tells us we're heading into a recession. But just because the broader market might fall doesn't mean your trading account has to go with it. We've been crushing it lately, and I think our uranium play still has more upside. Take a look at this chart. It's showing an inverse head and shoulders setup. There's the left shoulder, the head, and the right shoulder. Today, it's breaking into a key supply zone. If it clears the 6-month volume profile, we could see a quick move to $30, maybe even a breakout to $33. Thanks for watching.